In this video, we're going to be going over Chapter 11, Investing Basics, and looking at bonds and giving you some ideas on this. We'll also have a second video where I'll be showing you how to look up the information as far as bonds are concerned, so hang on for that one. In this video, this chapter, what we're getting into is the idea of investments. Now, first of all, you have to think about your financial goals. In other words, think about what it is that you want to do for the long term. When do you want to retire? What kind of money do you want to have? What do you want your life to be like as far as the end point is concerned? You have to think about establishing those goals. How much money are you thinking about investing? How much risk are you wanting to take on? Are you considering to take on? What are your investment goals reasonable? So here's some questions to ask yourself before you actually start doing any kind of investment. Before you do, make sure you're paying your bills, make sure you're managing your credit card debt, get rid of those credit cards, get yourself out of debt as much as possible before you start trying to invest, because the credit cards are going to be paying so much more in interest than you could possibly make in any kind of investment. Again, one of the things we've talked about is have your emergency fund set up where you have several months of living expenses just in case something happens, and also have another source of cash. In other words, like a cash advance or pre-approved line of credit. So again, when you start thinking about having that money to start some kind of investment program, pay yourself first. Okay, make sure you have that emergency fund set up. Take advantage of employer-sponsored retirement programs. In other words, a lot of companies will have situations where, or a program where they take money out of your paycheck before taxes, put that into a retirement account, and then they might match it for the same amount. If you have that, take advantage of it as much as you can. Maybe an elective savings program where your company automatically takes some money out of your paycheck and puts it into a savings account of some sort. So these are some ideas as far as how you need to make sure that you are getting set up to go into some sort of investment program. And always remember the time value of money. We talked about this from the very beginning. A dollar today is worth more than a dollar tomorrow. And the thing is, the more you put aside every month or every week, it's amazing how it will actually grow. When you're thinking about investments, there's a balance between safety and risk. The more risk you're willing to take on, the more possibility for better returns. There's also a higher possibility of losing money the more risk you take on. Some of the risk to think about, inflation risk. In other words, if inflation is going at 5%, you're getting 0.5% on your savings account, you're losing money. Business failure risk. You invest in a company of some sort. You buy some of the stock and they go under. You've lost your money. So there's various risks that come into any kind of investment program. Some of the things to think about also is investment growth. So in other words, you purchase some stock. One of the things that you are hoping for is the price of that stock goes up so that you can sell it and make money on that. Another thing to think about is liquidity. How quickly can you get your cash if you need it? What that is the ability to buy or sell something quickly without affecting the value. So for example, with a CD, some CDs that you might get from your bank, we talked about this before, you buy that and it might be for 3 months. Well, if you try to cash it in before then, they may take some of the principal. All right, so you want to make sure that anything that you have as far as liquid is concerned, you have access to it very quickly. Stocks probably do have a place in your portfolio as far as your investments are concerned. You just have to be careful which ones you're picking based on the investment goals that you have. One of the things you want to do is have what's called asset allocation and diversification. In other words, you don't want to put all your eggs in one basket, everything into one stock. That's a mistake. What you want is a certain percentage in different types of stocks and certain percentages in other things that are safer. So for example, the younger that you are, the more risk you can take on. And the reason is because you have more time to recover in case something happens. The older that you are, you probably want to go safer, more towards bonds and things like this. you can see that these are the types of investment alternatives that you have. You have corporate stocks, okay, where you become an owner in the organization. When you buy stock, you are now one of the owners. Corporate bonds, where you are lending money to a company. Government bonds, where you are lending money to the government. Mutual funds are actually combinations of some of these stocks. So in other words, what like an Edward Jones will do is they'll put together a mutual fund, and it might have 30 different stocks in there. Some of them are high risk, some of them are more investment grade. The whole idea behind it is to give you a little bit more balance. So when you think about the asset allocation and the diversification, you need to be thinking about what your objectives are, how much you're willing to invest, what your tolerance for risk is, things like that. The types of securities and the safety is kind of like this. The lower level, where you might want financial security, that's just cash. You know, stuff a bunch of cash under your mattress or something. CDs, U.S. government bonds. Safety and getting some income will be some select stocks and bonds. Growth is where what you're looking for is increase in the value of the stocks and things. Now, as you go up this, the more risk you take on, because up here at the top is speculative types of things, which could be very, very risky. You could lose everything, or you could make some big bucks. So when you start thinking about investment, you have to think about what kind of risk are you willing to take on. Some of the things that you need to think about in the investment process is make sure you keep accurate records, and this is primarily for tax purposes. Maybe the values and things change. You need to be able to have those records so that you can pay the taxes or get the credits wherever it's necessary. Right now, we're in kind of an economic crisis with the coronavirus thing that's going on. And one of the things that you're seeing is the stock market is going down the tubes. You have a lot of companies that have furloughed employees, things like this. This is why it's so important to make sure that you establish that emergency fund, so that if you have something like this happens, you get furloughed or something, you have at least 3 months of living expenses so that you can pay your bills while you're looking for a job, trying to get through some of the things that are going on. In that situation, you need to make sure that you're reducing your spending. If you can't make some payments, you're notifying the companies, and they're going to be willing to work with you as long as you're talking with them. You don't just go dark someplace. Now, what kind of investment options do you have? In this section, we're going to be talking about bonds. Next week, we'll be talking about stocks. This week, bonds. Now, with a bond, what you're doing is you're making a loan. When you buy a bond, you are actually lending money to a government, and it could be the federal government, a state, or even a city or a county. That's called municipals or municipalities or munis. Now, with the federal government, these are the safest investments you can make. And what the federal government does is they offer 3 types of loan options. In other words, you can buy or lend to the U.S. government money through T-bills, notes, and bonds. Bills are short-term types of things. What you do is you buy them at a discount. So let's say that you're going to buy a 52-week or a 1-year T-bill, Treasury bill. And let's say that the going interest rate is 4%. What happens is you buy it at a discount. So what you pay, $96, you get a bond for $100. At the end of the year, they'll pay you back the $100. Plus, you don't pay federal tax on the interest earned. I'm sorry, you pay federal tax but not state tax on that, on any of the interest that's earned. Treasury notes are middle term as far as the lending is concerned. You're lending money to the federal government anywhere from 2 to 10 years. And they'll pay higher interest than the Treasury bills will, because your money's being tied up for longer. Again, you'll pay federal income tax but not state tax. Treasury bonds are long-term, in other words, 30-year type things. And they'll have a little bit higher interest rate than the notes will. Again, and they pay interest every 6 months on these things. So you buy a note or a bond, and you will have what's called coupons. And what they'll do is they will send you interest every 6 months for those bonds or notes that you have. It used to be that you had a coupon, and what you did was you clip the coupon off of there, you submit it to the bank, and they pay you based on the coupon. They don't have they're really not clipping coupons anymore. It's all done electronically. So this gives you an idea as far as the differences between bills, notes, and bonds. Look that over in the book. Then what you have is are the local and state government securities. In other words, you're lending money to the city of Overland Park or to Johnson County or something like that. These are called municipals. It's typically used to fund building and various other things that they have going on. Interest is exempt from federal taxes. You don't have to pay federal tax on most of them. The thing is, if you buy one and later on you sell it before it matures and people really want it and you actually make money off of that sale, you're going to have to pay capital gains tax. There's two types of munis. You have general obligation and revenue. General obligation is basically where, let's say it's for Overland Park. Overland Park raises their right hand and they say, we promise to pay you back the money that you've just lent us. Revenue bonds are actually paid back through the revenue that's generated from that project. So for example, if they're putting in a toll road or something like that, the income that they make off of the toll road is being used to pay back the bonds. One of the things to think about is the yield, the taxable yield that goes with that. Because you're not paying income tax on it, you might have something, you might buy a bond that has a 5% interest rate, 5% coupon rate, but because you are not having to pay tax on it, it's like almost 7% as far as the yield is concerned. That's one of the advantages of buying municipal bonds. Now, corporate bonds are where companies are asking for loans and you're buying one of these bonds and you are lending them money. People will buy these because they are safer than stocks, because bondholders are paid. If a company goes under, a bondholder is paid back first before the stockholder is. You're going to have the face value. Normally, corporate bonds are issued at $1,000 increments. There's going to be a maturity date as far as when that bond has to be repaid. You have your indenture. In other words, it's a legal document that you get that says, okay, here's all the things that go on with that bond. Here's all the conditions, if it's going to be called, if it can be called, things like that. The trustee is the big money bank that's actually handling all that for that organization that's trying to get that big amount of loan. The reason why they do it is for major purchases and primarily to build new stuff. All right. In other words, they're going to build something new. What they're going to do is they're going to have a bond issue. And so you're lending them money to build that new building or whatever it is. There's debentures and there's secured bonds. You have debentures and secured bonds. A debenture is basically unsecured. In other words, the company raises its right hand and says, we promise to pay you back. A secured bond is basically secured by some sort of an asset. So let's say that they're building a building. Okay, they will use that building as the security for paying back that bond. If they go under, they can sell the building and that'll pay back the bondholders for that. A convertible bond is one where the money that you've invested could be converted into stock if the company wants to do that. In other words, they want to get away from having a loan and they would prefer to have those folks as owners. And there's different tax implications and things like that. High yield bonds are basically what you might hear of junk bonds. In other words, there's a good possibility that they're going to go under and you're not going to get your money back. But you could make some money off of those things as far as the interest rate is concerned if they do pay it back. Now, call features. What that means is the company has lent this money out and they have a call feature in there. In other words, okay, we've sent this out, we want a 10-year bond. But we might be able to call it back within 5 years. In other words, we've saved up enough money where we can pay off that loan more quickly. In other words, they're paying off their loan before the actual due date. That's a call feature. A sinking fund is kind of like a savings account, where what the company does is they will put aside money, okay, every month, every year, that sort of thing, in order to pay back some of these bond issues that they may have that are coming due. Serial bonds are where they will do a bond issue that goes over several years. So, for example, they're going to do a $10 million, let's say a company's going to do a $10 million bond issue. And what they do is they set up the first $2 million to mature in 2 years, another $2 million to mature in 4 years, another $2 million to mature in 6 years. That's kind of a serial bond type thing. Interest income is what you're doing, what you're wanting when you buy a bond. The whole idea behind that is to have that income that comes in every 6 months. There could be a dollar appreciation that goes along with that bond. In other words, let's say that a company issues a bond for, say, 6%. Then what happens is, let's say that the interest rates drop down to like 3%. Well, you could buy a bond that has 3%, or you could buy one with 6%. But if you buy the 6%, you're going to have to pay a premium for it. And so that bond has appreciated in value because of the changes in the interest rate. Most bonds are sold through those full-service brokerage firms. And so, for example, if you have a retirement account with an Edward Jones or something like that, you can buy some of those. We will talk about where to get the information in that next video, as far as how to find the various information that you need for those bonds. And in the PowerPoints, we have some sites that you can go to try to get some of that. Now, one of the things that will happen also is what's called bond ratings. When a bond is issued by a company, it's going to get a rating. And you can see that there are different types of ratings. So, for example, these A's here, that's high grade. In other words, there's almost a zero chance that you're not going to be paid back. But the thing is, the interest rate's going to be a little lower. Again, it's that balance between risk and security. Medium grade, okay, you can see the letters for that. As far as the ratings for that, they may possess some speculative risk, but there's a pretty good chance you're going to get paid back. When you get down here to the C's, that's junk bond areas. Okay, in other words, you might buy one of those bonds and maybe pennies on the dollar, and there's a good chance that you won't be able to get paid back. However, if you do get paid back, you've made some pretty good bucks. So those are some of the key points from this chapter. Look at the next video that we have out here, and that's going to walk you through how to actually look up the information that you need for the exercise.